Most people, not you guys, but most people are on the left side of this diagram. This is where most Americans live. They follow the common advice. They are borrowers. They save money. They eventually accumulate $40,000 or $100,000 or whatever the thing they're buying costs. Then they go out and they buy the car. And what happens? Immediately, boom, down to zero. That's the compounding clock resetting. Then they start saving again. They build up until the next purchase resets it again. And they do this over and over and over. And later, I'm going to share how much money they're losing out on over time. Let me ask you a question. If you were to buy a $40,000 car, what's the smartest way to do it? Most people would say, pay cash, no debt, no interest, and that sounds responsible. But earlier this week, I was on a call with a couple who had over $500,000 sitting in savings and other accounts and more than $1 million invested in the market. And they were pretty excited about where they were at. They were disciplined. They were doing exactly what most financial advice tells people to do: accumulate, save, invest. And then their question was simple: should we just pay cash for the car? And that's when I explained something most people never realize. When you pay cash for a vehicle, you may be actually buying that car twice. I'm going to say it one more time. When you pay cash for a car, you may actually be buying that car twice. And today, I'm going to show you why. Now, here's the important part of the story. This couple wasn't reckless. They were doing exactly what most financial advice tells people to do: accumulate, save money, put money in a high yield account, invest in the market, build your net worth, the common path. They were following the common financial advice of accumulation. And accumulation is good. Accumulation does build wealth, but accumulation alone, going up the mountain, does not give you control. Because when it comes time to actually use their money, they only had the same three options as everyone else has: spend it, borrow it, or rent it. And that's where the system quietly breaks. And there's three ways that people buy vehicles. First, we pay cash, right? Second, we finance it and we pay interest back to the bank. And third, we lease it, which is basically renting the vehicle. And leasing is the most profitable for the dealership. And technically, there's a fourth option. Now, I know none of you would do this, but you could steal it. And that's probably not a great long-term strategy. Most financially responsible people believe paying cash is the smartest option. But there's a hidden cost almost nobody calculates: opportunity cost. And this is where the conversation changes completely. And this is one of the most simple yet powerful questions you can ask yourself. I ask this all the time in my strategy calls. When I spend this money, will I ever make money on this money again? If the answer is a resounding no, the next question is obvious: how could I? When you write a $40,000 check for a car, two things happen immediately. First, the money stops working. Second, the compounding stops. Your account drops to zero, right? The zero line. Robert Kiyosaki calls it the rat race. That's why so many people stay stuck here. Every time you spend the capital outright, you reset the clock. You start over. The game starts over. The compounding stops. And you have to rebuild the capital from scratch. You have to go out and work, trade your time for money. And remember, this couple, this example, they had plenty of money sitting in other accounts. So this wasn't about affordability. It was about optimal action. It was about efficiency. And this is where we introduced this couple this fourth way to buy the car. So what could they do instead? Instead of paying cash, instead of borrowing from a bank, you capitalize your own banking system. That's right. You become the bank. What a wild idea, right? This is the infinite banking concept. Your capital goes into a specially engineered whole life policy. Now you're giving that same dollar 3 jobs. How many of you want to give your money 3 jobs? Job number 1, it's saved and growing, guaranteed and tax-free. Job number two, you can borrow against it like a line of credit. Job number three, it protects your family with a death benefit. So you're saving, spending, and protecting, or saving, financing, and protecting simultaneously. And the biggest question people ask at this point is, how is that possible? Is that even legal? So let me show you what's actually happening. I thought this visual made it super simple. Most people, not you guys, but most people are on the left side of this diagram. This is where most Americans live. They follow the common advice. They are borrowers. They save money. They eventually accumulate $40,000 or $100,000 or whatever the thing they're buying costs. Then they go out and they buy the car. And what happens? Immediately, boom, down to zero. That's the compounding clock resetting. Then they start saving again. They build up until the next purchase resets it again. And they do this over and over and over. And later, I'm going to share how much money they're losing out on over time, right? Long term. So, what happens when you move to the right side? Now you're buying the same car. The purchase happens, but the capital never leaves the system. The clock keeps running. That single difference changes the trajectory of your finances over decades. This is what wealth builders do. Hey, listen, if you're enjoying this content, if you're finding it valuable, make sure that you're subscribing to the channel, that you're smashing that button, and that you're ringing the bell to be alerted to new content. Connor says it might just turn blue. Make sure you get alerted to all the new content. And let's get back and see how the uncommon path keeps more money in your system. And every mutually owned dividend paying whole life insurance company that we work with, they've all been profitable well over 100 years. Every year they've been in business. That is crazy. The youngest company we work with is 121 years old, 1905. Why? Why and how, right? You're wondering that because they're only betting on one thing, that their policyholders will continue paying the premiums. The money they hold is invested in very conservative long-term assets. Often they own the majority of the commercial real estate in the city they're in. And those long-term assets, they create a spread. That spread allows them to guarantee growth, contractual growth. They guarantee the cherry on top to maintain liquidity. High liquidity, massive amounts of liquidity, and historically pay dividends every year, which means your capital keeps growing even while you're using it. So let me show you what it looks like when we're talking about that $40,000 vehicle. Let's look at the math. When you look at this chart, right? Look at the example. Most people simply write the $40,000 and hand it over until one day you're going to want to tug that back. Money's gone. Clock resets. But imagine the $40,000 stays inside your system and continues compounding. Let's say it grows at an internal rate of return of 4% annually. Nothing aggressive, right? Safe, slow, steady growth. Not sexy, but over 25 years, 40 grand becomes 106,000. Over 40 becomes $196,000. And it's tax-free. That's right, it's tax-free growth. So think about what just happened. You bought the car, but the money never stopped growing. You didn't return to the zero line. And as you replenish the system, right, the same way you would pay if you finance it back to yourself, to your family, the next vehicle you buy is actually paid for by the growth of the capital. Eventually, you start making money on all of your vehicles. And that example is helpful because it just shows the math. Now let's look at what I call stop the bleeding. When you have money and interest leaving your family, you'd want to know, how could I stop that? How could I put things and switch the environment into my favor, right? And when we're looking at this client, again, they had strong assets. They had money scattered across accounts that were doing three things: barely growing, fully taxable, and offering zero protection for the family. At the same time, he was paying interest back to the banks. He was bleeding. So the first thing we did is we redirected the flow. We changed one thing. Instead of sending the capital into the banks first, he ran the capital into his policy. Then about 30 days later, He borrowed against the policy, right? He put 10,000 in annually and overfunded by 50. He took out enough in the first 30 days to pay off the vehicle. So now instead of paying interest to the bank, he's paying principal and interest back to his family system. Same money, same purchase, different direction. Instead of flowing out, it's flowing back in. And here's the part most people don't expect. After about 2 years, the premium deposits become more efficient, meaning the policy is now creating more tax-free growth than what he's putting into it. And it gets better every single year. So once that capital is redirected, once we've changed one thing, the next question becomes, what happens to the debt? Let's look at the difference in the debt. If you followed the common path, I call it the traditional path, the way the banks want you to do it, he would have paid $7,260 of interest to the banks over the next 4 years. Even if we applied normal financial math strategies, meaning math, he'd be out of debt a couple years earlier and save a little bit of interest. But when we switch to the infinite banking concept, he eliminates third-party debt in about 2 months. From that path or point forward, he's paying his system back. That money that was flowing out is now replenishing his own system. By June of 2028, he's going to have fully replenished that capital while the money inside the policy never stopped growing. And at the same time, his family now has over $692,000 of protection, right? 3 jobs, saving, financing, protecting. Don't we all want our money to work a little bit harder for us? And that's the part that most people miss. When you combine that structure with long-term compounding, something very interesting starts to happen. I touched on this a second ago, right? The amount that $40,000 grows, but let's zoom out on our thinking for a second. If that's one period of time, imagine if you're buying a vehicle every 5 years. Most Americans, they're buying 13 cars during a lifetime. So if we go out further, this guy's 56. If he goes out 40 years, it's $192,000. And here's the crazy part. He didn't invent new money. He didn't earn more income. He didn't take on any more risk. He simply changed where the money went first. And when people see this for the first time, the reaction's usually the same. What? Why aren't we taught this? Below in the chat, tell me that. Answer truthfully. Why aren't we taught this? That question is exactly where the real lesson begins. Because most people think paying cash is discipline. Sometimes it is, but financially, you reset the clock every single time. And we know that discipline is good and paying cash could be okay. But financially, again, it just brings you back to that zero line. Builders, they think differently. They keep the capital intact. They allow it to continue compounding. And then they finance their life from their system, from your system, which means the money keeps working long after you purchase or after the purchase is gone, after that vehicle is gone, after you need to replace it. And one of the things I tell people all the time, I tell clients all the time, it takes about 2 years of patience to have a lifetime of profitability. You're building a warehouse of wealth. But once that warehouse is built, everything changes. So the real question is not, can you afford the car or should you pay cash for the car? The real question is, do you want to spend your money once and keep it working forever? Because the way most people buy vehicles, they quietly drain their wealth over time. They lose tons of opportunity cost. That's the way borrowers go. Builders keep the capital. They finance their life from their system. And that's exactly what we designed during the strategy call. We open the vault, we look at your capital, we look at the opportunity cost. I meet you exactly where you're at. I help you see that progress is possible from this point forward. And then we tie that to where you want to be in 10, 20, and 30 years. We design your own personal, specially engineered banking system. And if that's something you want to explore, schedule the strategy call down below. Be blessed. If you found value in this conversation, smash that like button, subscribe to the channel, and invite others into our big ass infinite banking bus. It's not for everyone, but there's plenty of room and everyone is invited to ride. You want to get off? That's cool too. If you want to keep going deeper into this infinite banking concept and learn how to control your capital, watch the next video right here. I'll see you there.